I'll take you on this video from part one, where market makers model, to be able to transition to the advanced level of market makers model. We're going to go in depth and full steam on the actual market makers. So this might be a bit intense, but you will be able to correlate it later down the road with the existing confluences. So have fun. Now, going over the smart money reversal, and this is where a lot of people will be struggling to spot. And if you're able to spot this, then if the lowest buy, you'll be on the safe hands. And why? It's because prices on go up if you're spotting the right money reversal. A lot of people try to identify it. This is why the full guide, and this is all the confluences that you will need to spot it. So this is your full guide here. All the confluences. This is the first confirmation of the start of the market makers model. Okay, so in a market makers buy model with SMR, smart metrical risk, goes to a sell program to a buy program. In a sell model, it's going to go from a buy program to a sell program. How to spot these reversals, right? So we got this blue area, and this is our higher time frame point of interest. First thing that we're going to be looking at is the higher time frame PD array. Price needs to go and trade into a higher time frame PD array, and we're going to be talking about what is higher, because higher is relative, right? So we're going to be talking about the time frame alignment here, and we need to be on a higher array. So I really prefer fair value gaps. Second thing is liquidity sweep. So remember this rule, and this is a rule that I want you to take note of. Simply, you'll be getting a higher win-win reward using this. We don't validate higher time frame PD array unless there is a liquidity sweep. We only don't validate the liquidity sweep until it's inside of a higher time frame PD array. So there's two things, 2 and 3. These two things always need to be aligned with each other. Liquidity sweep and higher time frame PD arrays all happening at the same time. So this is our liquidity sweep, and this is our PD array, the whole thing. Now, one thinking is SMT, the divergency. So what is that? So if you should know, if you don't, this is when we have two correlated pairs, let's say, for example, EU and GU, for example, euro dollar and pound dollar. Those two pairs could be correlated, right, with each other, directly correlated. So when one is going up, the other one should be going up. Let's consider this as Euro USD. You see this low was taken there, but in pound dollar, you could see something like this, and now going up from there. So not taking this low. So that's an SMT divergence. So you'll also be using the SMT divergence. It's a very, very powerful tool in order to spot the smart money reversals. That's one other thing that you need to. So it's number one here. So for example, we have this SMT here. Now the fourth thing is the market maker, market structure shift. So you can see how we're coming lower, and we're going lower, and then somehow going above the last high. You see, we have like this, and it's closing above. Then that's a market structure shift, and also confirms, especially in the higher time frame, confirms a start of a market maker model, or at least it confirms this smart model reversal, which is the start of a market makers model. So if CISD is a change in state delivery, so you can see that we've been creating a bearish candle, bearish candles, bearish candle, bearish candle, and then all the highs of the bearish candles are predicted, so we have no closure above the high. So it keeps on leaving until we get point of interest on a higher time frame one and the liquidity sweep. And somehow what we have is a bearish candle, and then an engulfing candle that it closes above. So we have a closure above this bearish candle. This is a sign of our smart money reversal. This is a sign of, okay, now we're starting to go up, and this is an early indication of a market structure shift. So if we have this, then it looks like that in the future we're going to have a market structure shift. When we have these two things, as well as the SMT divergency, and I know that like mostly now we have a smart money reversal. The last thing that we need to look at, and do not underestimate this, so we know that F fairly gap is most of the time that equals to displacement most of the time. So in order to validate this as a displacement and has a smart money move, we need to have a fair value gap. So creation of an FVG, it will create a story, and it's going to be narrative. When you have a fair gap that tells us that most time frames, the higher time frame and the lower time frame, are aligning in the same direction, and that's the hint that you will have from the creation of the fair value gap. So you always need to focus on this creation. When I have those 6 things, or maybe 5 of them, most of the time this is going to be a really smart trade, and this will be expect an expansion to the upside. But you can always expect the lowest buy, and it's going to take reaccumulation phases and so forth. Now, market maker's model secrets. Market maker's model is complicated, so here's the simplified version. Let's try to simplify this, and it might be initially too much, but it will be important because it creates a narrative for the existing whole strategy model that we currently have. So why trade market maker's model? Why do I need this stuff? The reason is market maker's model is created to convince you to sell in a bullish market and while the price is going up, and buy in a bearish market if the price is going down. So we consider this price action right here. You can see that we have a range. We had a breakout to the lower side, another range, and another breakout to the lower side. A lot of people will be trading ranges and then creating a new low. You're looking for an FVG, fair value gap to hold, and another fair value gap, and then basically people say, oh, this is a clear bearish market structure, right? Clearish bearish daily bias, but when you understand the market maker's model, you'll know that you're actually able to buy into this bearish market. And if we have a market maker's sell model, for example, even if price is going up, you know that it's will start going to sell from there, even though the price is going up. So that's one of the advantages of understanding the market maker's model. Everyone is going to tell you, oh my God, you are against the trend, but you're going to tell them, oh no, I understand the market maker's model, I understand the importance of it, and I know that smart model reversals is close to happen, so I can actually sell from here or take the lowest buy. When you have a very clear consolidation for you, when you have an SNT, you'll know, okay, price is starting to move from HTF POI from a sell program to a buy program. You'll be mainly buying against the whole trend. You'll know that this trend is going to be taken as high as going to be taken. Massive risk reward, and this is how you can actually be trade against the trend, just by understanding market maker's model. Now, if I ask you what you see here, what is this? Price is coming lower, and then what? Going up. And what is the relationship between this one and this one? Or this and this one? What is this? This is a balanced price range where price delivered the sell side very quickly and immediately delivered the buy side, and usually these are overlapping fair value gap here. It's one of the ways to look at, right? But if you look at the higher time frame, you're going to be seeing this, simply a bearish candle, bullish candle. Both signs are delivered in 2 candles, right, on a higher time frame. So what is this? A balanced price range. So if we connect this to this, it's going to be actually a higher time frame of this. So market maker's model is nothing but a buy side and a sell side curves, which is equal to what? A balanced price range, BPR, on the higher time frame. And market maker's model is nothing, again, but a move from a PD array to another. So we have PD array here, and we have PD array here. So move from 2 PD arrays, and this could be PD array of higher low, or the block and fair value gap, for example. Usually we'll be moving for a higher low into a fair value gap, or from a fair value gap into a higher low. That's always the case. Internal liquidity, external liquidity, we're going to discuss this later on. Fair value gap is nothing but a liquidity. Again, this is another thing that you should be aware of. Market maker's model is it's actually a move of premium to discount and discount to premium. All right. So this is the real market maker's model. So moving from what? Premium to discount. Discount again to premium. That's the move. Balanced price range. Like this, or on a higher time frame, something like this. That's simply put it. Okay. So how do we identify the market maker's model, right? We understand that this is the market maker's model, right? But actually this is nothing but how it looks on the lower time frame. This is how it looks. We have a high time frame point of interest. Smart money is going to happen here, sell side of the curve, buy side of the curve, and then we go up. On the higher time frame, nevertheless, and this is how we identify market maker model. We're not going to identify it on the lower time frame. We're going to looking at something like this. It's going to be very hard to identify, but we're going to look at it for go higher to the higher time frame, and you need to understand how the markets move. If not, make sure to see how the actual market price moves. So price moves from where to moves from internal to external or external to internal liquidity. What is external? Highs and lows. What is internal? Fair value gaps. So internally, it's a fair value gap in a dealing range. Dealing range, for example, from this low to this high. In between, we have what? Fair value gaps. The high and the low are external liquidity. Again, price moves from where to where? External to internal. External from this high to this fair value gap to internal. And then what? The internal to external is going to be from this fair value gap going up. So if we're able to identify this type of move, which is the external to internal or internal to external, and usually I would really prefer to look at it to the internal to the external, that's your buy model, right? So this is how it looks on a higher time frame. And this is the balanced price range that we're having. So by having this identified, it will simplify your understanding of the lower time frame. So smart money reversal here, higher time frame. This is exactly, and we're going to be focusing on, and this is actually this one, the internal fair value gap, right? So we'll have a liquidity sweep here and a smart money reversal here, the lower risk buy here, and everything happening here like this, like we've seen before. But simply, we only identify a higher or low in a fair value gap on a higher time frame, and we see what's happening there. What is the type of the move that is happening as of now? Do we have an external to internal, an internal to external, and we go from there. And this is how you actually identify the markets maker model, simply by looking at the higher time frame. When you zoom into the lower time frame, you're going to see all those tiny little phases. The original consolidation is just right there. The higher time frame, this is the one. Original consolidation is going to be right here. This is the liquidity. I mean, it makes sense, right? I mean, higher time frame with targeting external, low time frame is going to be original consolidation. You're going to see all the distribution phases, accumulation phases, all seen on the lower time frame. But in order to identify MMXM, we're going to be focused on the higher time frame. And again, we're going to be talking about the time frame alignment on the next. Now, again, looking into directly to internal to external liquidity, there's a relationship between them both and market mix model. So the relationship is between external, internal, original consolidation, and smart money reversal. I know that price moves from external to internal or internal to external. So when we have a fair value gap, we have an internal to external move. Then we know that the original consolidation is going to be targeting the external, and the smart money reversal is going to happen on the internal. And then the market maker's buy model in this will be completed when that high is taken. Now, again, we can see what we have, a move of external to internal again. Now we can have another market maker's model there on the lower time frame, but what we'll have again, original consolidation here. At the high, we'll have again, internal reversal going to the upside, taking liquidity again. And this is the relationship between external, internal or external, and original consolidation and smart money reversal. So by understanding of this and the higher time frame, you're going to be easily able to identify the models, the original consolidation, and always the smart money reversal, because it's going to be definitely inside of the fair value gap internally. Now, time frame alignment. That's where everything is going to be. So market maker's model is nothing but going from, again, a higher time frame where we have a PD array to the lower time frame where the market maker's model is going to be. Seen clearly, right? Higher, this is an error, but like, I need to fix this somehow. Let's identify this as an error, okay? If we're looking at the monthly PD array, then we're going to have a market maker's model on the daily. Same thing for the weekly, daily. Daily, for example, we have, let's say, daily fair value gap, right? Then we'll have 1 hour market makers model. Same thing here for our PD array. We're going to have a 15-minute market maker model, a 1 hour PD array, 5-minute market makers model, and we can go all the way to 15-minute PD array and 1-minute market makers model. So we're going to look into examples into different time frames, and we're going to try to engage with all these time frames, and I'll show you how we can go with this stuff. Again, market maker model is nothing but a move from a PD array to another, a premium to discount, discount to premium, and we're going to be able to identify this into proficient in your trading. So how do we trade this stuff? That you'll really need to understand is the part that maybe you'll be waiting for. So let's try to go deeply into the market makers model and how we can actually execute trades using this stuff. So I have some steps here, 5. If you follow those, it's a clear procedure for actually identifying and using it, okay? So first thing is to identify higher time PD array. You can see prices going up, and then we have a higher time frame PD array here, only higher time frame. And then what we identify the move. So we need to understand, is the move external to internal or internal to external? In this case, what is this? Simply, this is external taking here, coming back to internal, right? And now we know that this is smart model reversal is going to be happening on the internal, on the fair value gap. And the original consolidation is going to be at the external. We identify the original consolidation and stages of accumulation and lower time frame. So that's the one. Original consolidation here. We're going to be looking at the distribution phases here, distribution, and then fourth one is look for the smart model reversal using the confluences that we were mentioned before. So we got 6 confluences. Let's use all of those, or a few of them at least. Liquidity sweep, SMT divergence, market structure shift, again, changing state in delivery, and creation of a fair value gap. All these confirms to you that this is a smart model reversal, and then we know, hey, market is turning bullish. So then let's involve the entry. Now we're going to use the fair value gap mitigation or a stop hunt to enter. So we have 2 types: either wait for them to fair value gap mitigation, fair value gap here, and we wait for the mitigation, or simply we look for this liquidity sweep, right? So these are the 2 types to focus on. And then we target the original consolidation, either entering at the low risk buy stage or the accumulation or the reaccumulation phase. Any of those stages you can actually execute a trade from, and that's the whole plan. That's it. And we're going to go for examples and apply all these steps one by one and show you how you can actually approach this stuff and make you a beast on trading. So original consolidation coming low, HDF PD array, reversal, confirmation, entry point here, accumulation, reaccumulation here, using either a tiny liquidity sweep or mitigation of fair value gap. And then we go targeting what? The external liquidity. It's going to be broken for liquidity to be swept, or the original consolidation on the lower time frame, which is the same on the lower time frame. I'm pretty sure and pretty confident on the whole steps are very clear, and without even getting any examples, I think you can actually go and apply this. But the last thing that needs to be covered that I decided to mention here also, it's going to give you a very nice framework before going into the example. This is the market makers model, swing grading. So in the swing or the dealing range of the market makers model, in this case from actually the original consolidation to where we expect the smart money reversal to happen, or where we confirm it, a market structure shift, then we take a fib with these values 1, 0.75, 0.50, 0.25, and 0, and all these values we drag our fib to the high, to the low, or the opposite. So near the 25% from the 25 to slightly above it, slightly below it, that's the area where normally you're going to low for the low risk buy or sell. Just have to create something really important information for you. This is pretty much where it's going to, most of the time, it's going to present itself. you're going to look at to the 0.25% of the dealing range, the 0.50% of the dealing range. As prices goes up and we already have the smart money reversal, we have the roll risk buy. Usually the price will make a displacement here, creating different types of gaps. Breakaway gap actually, which is unfilled, which stays unfilled, or we create different value gaps, or it could actually create order blocks that are respected. We look for these order blocks to be respected, but as I said again, price can go back to the order block or can create a breakaway gap and not fill it. And we go up from there. You can look for it at 0.50% on the dealing range, and that's 75%. What we look for is, because we're very close to the original consolidation, we passed equilibrium and we're entering into premium. So what's mostly going to happen is displacement. And when does this displacement happen? When there is a lower resistance to liquidity one. At this phase right here, we can find an entry at the second stage of accumulation or reaccumulation. And then we're going to be actually entering here and wait for the displacement to happen. And most of the time this happens at 75%, taking all of the lower resistant liquidity here and going into the actual origin consolidation above it. So at this stage it will be very clear, and it's going to be see prices actually running all of those lower resistance liquidities and add the one. This is where the market makers, in this case buy model, is actually complete. For the example, one for weekly, in this case, let's go to the weekly time frame, Euro US dollar time frame, and we have a chart, right? So looking at this is the weekly. We can see that what's happening here is price going up, we have coming lower, and we're having something like very clear, a high and a low. This high was taken, this high took this high, and this low took this low and this low. So what does that mean? Have a dealing range from this high to this low. Now in this range, broke structure to the downside, and now we have this move of external to internal. Now we ask ourselves this question: above the 50%, so this dealing range above 50%, which is almost here, any fair value gap that we can actually take a look at? There is no fair value gap that we can see except this one. Fair value gap from here to here with a higher inside, simply buy side liquidity inside of a big fair value gap. So this fair value gap with this liquidity here, it could be the move of this external to internal. And now what do we have? The internal reversal and the internal to external reversal. So IRL to ERL to ERL could also happen here, but so we not confuse, because this is still an external on the lower time frame, but we have a move from here to here, and it's going to be a huge move already on the lower time frame, which is going to be 1 hour based on the time alignment. So we can have a move from here to here or a move to here to here. So both are going lower. Now what we do is simply go to the lower time frame and look for our entry type there. Now kind of map the things there. So 4 hours, right? And we look into change in instant deliver or any type of input that we can. What we can see here is this is the low that we marked on the weekly time frame. This is where the price started to go up, and when we notice from this consolidation that it has this low and then higher low, and then higher low and then higher low. So simply low resistance liquidity. And as I said, this is the best type of original consolidation that we can actually expect and target. Price started going up, going lower. First stage here, going up. And now what do we have here at this point of interest inside of the fair value gap? You can see that price was approaching this fair value gap on the lower time frame. Bullish candle, bullish candle, bullish candle, and then a continued bullish. Here's a bearish candle, but it's still an inside candle, right? And then we have this big displacement, and this is where your change in state deliver is. So starts coming lower. Could have taken an entry here based on the CISD with a stop loss above the high. This is one approach, and another one would be waiting for the market structure shift, right? Maybe this one, which is more of a valid pullback. But if you look at this last major swing low before this price, before this week of liquidity and price coming into this point of interest, going to be this one, right? When we have the closure below. After the closure below, do we have a fair value left? Yes, we have. So there was also this high, and we can actually entry based on that stop hunt right there. And I call this this one live actually on an existing Discord training. This is pretty much a very accurate level to call. So we have the stop hunt here, and when we have entering is actually price coming into the fair value gap, goes above the high. Another way of entering is waiting for the stop hunt to happen and intervene from here, and the stop loss above the fair value gap, and that's another entry, right? So you can see, looks, there's a secondary phase here, so equal highs, and then started going lower. If you don't get this entry on the lower risk sell in this case, so price will continue lower, offer you another opportunity with another fair value gap, and with another liquidity sweep here, or this one, again, stop loss above the fair value gap. And then we have the sweep of the high. This is the second stage of a distribution. And what you can see here, there's nothing but a liquidity run, as you can discuss on the grading. There's nothing here but displacement and low resistance liquidity run, targeting the actual opposite side. And here on the second stage, almost at, if we take a pip from the high to the low, going to be on the last quarter, 75th percentile. And we see here nothing but a liquidity sweep and the displacement running all those lows, taking all the whole sell side liquidity. This is an example of going from the weekly to the 4 hour. I hope this is beneficial. So whatever type of entry you prefer, there's a lot to choose from. And I hope this model makes a lot of sense, because the market keeps on repeating this day and day and day and day and day, different pairs. You will see this everywhere. But first you need to understand it so you can start seeing it. So it's your choice at the end. So a second example is on the 4 hour. Then we're going to target the 15 minutes. Same logic, just to show how the market is fractal. What we see here, simply price going lower, creating this range, right, from this low to this high again, high above. And we have a dealing range and fair value gap on the premium here. It's this fair value gap, so the extreme one. Now we can fair value gap here, map it, and this is the ones that are mapping are the ones that are with the highest probability of working. So new low, and we have new liquidity level there, and simply what we have here is a move of internal to external. So this is how it looks, right? Price is approaching that fair value gap and taking liquidity level, which is this liquidity level, and now price is into the inside of a fair value gap. So based on this time frame, 4 hour, what do we see here? You can see an original consolidation on the lower time frame, smart money reversal on the FEG, and those stages going all the way. So you can easily understand where the market is going. That's how I see it. So you can go to the lower time frame and see it more clearly. Okay, let's throw to the M15. And let's see what we saw on the 4 hour. Price literally going into the, so there's a liquidity sweep right there, going into the fair value gap. Now, change instant delivery immediately, massive fair value gap. That's your low risk sell after the stop hunt. And then we get another entry, which is price making this market structure shift with the fair value gap, and price came to that fair value gap again with the stop hunt. Remember, when we have a fair value gap, but also there is a stop hunt or a liquidity sweep into that fair value gap, this is how we can find the highest probability of trade, okay? So fair value gap, liquidity sweep, lower, another fair value gap. So this is where the displacement starts. So you see immediately after price coming into this fair value gap, what do we have here? Or this is the original consolidation, nothing but the lower resistant liquidity again. And what happened is that price is filling this tiny fair value gap and immediately took all the liquidity there, and in another entry is an stop hunt there and going low, but most likely it's already taken there. So that's another way of entering. Exchange of state delivery, market shift, and look for your point of interest, either fair value gaps or simply mitigation of these fair value gaps. It's your choice at the end. So let's try another example, 15 minutes. So see how we're going to the weekly, to the 4 hour, now we're going to the 15 minutes as the higher time frame. I just wanted to show you how fractal the market is. This works on all time frames. Markets does the same on all different time frames. So if you know how the market works, you can see it the same results on all the time frames. So what do we see here? This still range from this high to this low, because we took the liquidity level after this liquidity sweep. What do we expect? We expect price to go to the internal, because we're having a small move of external to internal. Now this is the internal that we're having, and there's another one here, which is the extreme one. So at this case, because this is already almost at the equilibrium of the range from here to here, then if I have a confirmation, I will enter. If not, this is D1 extremes. If you were a beginner, I would suggest you only accept the extreme ones, but then if you're going to advance, you will know how to identify which are the good ones and the ones that will not be targeted. And make sure that you also trade the ones that are actually targeting. But make sure they're always in the premium or but not something like that. This fair value gap doesn't really make sense, so it has to be inversed. You see, inversed, retesting, going up, and we have this external here. So this is where we expect the original consolidation to be, smart money reversal, and then go lower. Going to the lower time frame, and it's going to be a 1 minute time frame. What do we see is again original consolidation. And I guess this was the first time that I explained what's this price sweeping and then going up. So that's an original consolidation. It's not the highest probability one, but it's also can work. And price respecting this fair value gap, going up almost at the equilibrium of the range. Going up, and we have this liquidity level that is swept. No market structure shift. And then what we do? We come lower, hit that FVG, and we target price going inside of this fair value gap, slightly underneath the 50%, and then we have the market structure shift. And now see how every fair value gap is going to push price lower, and every fair value gap is going to be bullish, going to be disrespected. This is how it goes. So every order block here, every up close candle is going to act as a resistance for the price. Every candle. So this is a bullish candle and pushes price lower. Bullish candle pushes price lower. Bullish candle pushes price lower. And then again. So this is how you know that you're in the right direction. So bearish fair value gap being respected, bearish order blocks being respected, bullish and order blocks being disrespected. And what do we see here? This order block entry here, fair value gap entry here, fair value gap entry here, the whole stages of distribution at this case. Coming lower, we have a stop hunt, and you have the second stage of distribution, redistribution, where we have a liquidity sweep into a fair value gap and an order block. And then what happened? Displacement immediately to where? To the original consolidation. So this is a very high probability entry when you look at, and you have the time frame alignment. It is very simple. It's nothing that you will lose 10 minutes with it. Lower time frame, higher time frame, lower time frame. What we'll do is look for the internal to external or the internal to external. Basically a point of interest, because we know that as of now that we're almost at the third example now. Because we know as of now that in general, market maker's model is nothing but a move from a PD array to another, simply from a fair value gap to a liquidity pool. Simply, that's pretty much it. When you have someone that is simply, yeah, it's being just complicated. When I started learning market maker's model with Michael, everyone was like, drawing something like this, going up, and I was like, what is that? And how do I identify, how do I see it in the chart? If I see price going up like this, am I not able to identify this? But now we just know that if we go from a higher time frame to another, and you know now that this low is the external low, it's nothing but an original consolidation of the lower time frame. So this is how we master the actual concept. So this is pretty much the end of the course. So this is really premium information, and what I actually hope is that you guys appreciate what currently is provided and the value that it currently has and it gives you for the future, and how you can actually start the day by understanding where the market is going by a market maker model, and apply what you already has skill sets in your tool army set. This is Mike, and I'll see you on the next one.